Hello and welcome everybody to Elevate Wealth Advisory's March webinar, Top 10 Tax Planning Tips. I'm Betsy Kenyon. I'm our marketing coordinator here at Elevate Wealth Advisory. If you're new to us, we are a wealth advising firm in Athens, Georgia. We were founded 40 years ago in 1982 by Chuck Vickery as Vickery Financial Services. And since that time, we have rebranded as Elevate Wealth Advisory, and our team has now grown to 11 people. We do these webinars every month, and this month's topic is your top 10 tax planning tips. And before I introduce you to our speaker, which is our current president and CEO, Deanne Rosso, I wanted to go over a couple housekeeping items with you. If you look at the bottom of your screen, you will see both a chat box and a Q&A box. So throughout today's presentation, if you have any questions for Deanne, feel free to pop those into either of those spaces, and we'll make sure that your question gets answered. If before the end of the presentation, it's getting close to 1 o'clock and we're running out of time, we'll make sure we get back to you about your question by the end of the day through email. And then also at the end of this presentation, I'll be taking all your questions and answers for questions for Deanne. And then I will also be sending you a link to the recorded video on our YouTube channel so that you can share that with any family or friends that you have. So today I'm so excited to introduce you to Deanne Rosso. She is our current president and CEO. Deanne is a proud University of Georgia graduate, and she joined the firm in 2005, back when it was still Vickery Financial. And then she took over the firm as president and CEO in 2018. Deanne lives in Watkinsville with her husband, Brandon, and their 3 boys, who are all University of Georgia fans. Welcome, Deanne.
Thank you, Betsy. I'm so happy to be here today. Is it the most wonderful time of the year, tax season? Am I right? If you are agreeing with me that it's the most wonderful time of the year, maybe this isn't the right webinar for you. But if you just love tax season so much and kind of feel the pinch during tax season and want to know some ways that maybe you can be a little more effective in your tax planning, then you are in the right place today as I share some top 10 tax planning tips. A lot of these are things that I share with our clients on a daily basis and look forward to sharing with you. Disclaimer, we are not tax preparers. We are not accountants. We are not CPAs. So why are we sitting here talking to you about taxes? And it's because we know that taxes are one of the things that to some extent, we have a little bit of control over when it comes to our financial situation. We know that there are strategies and tips and things that we can do to help minimize the tax bite, if you will. And what we think is if we can help minimize the tax bite over time, that only stretches your assets, your resources, and allows you to pursue a more successful investment and retirement experience over your lifetime. So minimizing taxes is really important to us, and it's something that we build into all of our client financial plans. So without further ado, let's get to it. I put together a few slides to show you guys today, and I will pull those up and share with you our top 10 tax planning tips. I've tried to do this in a way to make it a little interesting. So I hope you find interesting my little quips and phrases, catchphrases maybe that I've used to help explain each tax planning tip. So here we go. Number one thing that I think is most important is know thy tax return. Too often, I think if I ask someone, did you get a refund or did you owe tax this year? I think we can all pretty much answer that question when we've gotten our tax return back. Oh, I owed. Oh, I had to pay in more than I thought I was going to. Or yeah, I got a refund. It's awesome. So a lot of times we always know, like, did we get a refund or did we have to pay tax? But how often do we actually look at our tax return? And you can glean a lot of really helpful information just by taking a look at your tax return. So I've put a little snippet here of the Form 1040. And again, too small for you to read on this screen, but I highlighted some areas of the most important information. The top half, and by the way, this is a new 1040 that was implemented after the Tax Cuts and Jobs Act of 2017, which that act was designed to reduce the amount of paper effort that goes into filing your tax return. As they said at the time, you know, hopefully this will make it where you can file your tax return on a postcard. Well, it's not quite postcard size, but it is a little bit shorter, or at least the first couple of pages of the 1040 than it used to be. But basic information that you can look for on your Form 1040 is, of course, the first half is personal information. You've got your names, your dates of birth, social security number. I'm sorry, not your dates of birth, but your names and your social security numbers, your address. Make sure your address is right. Always check for accuracy of your information. Probably one of the most important things toward the very top of the form, right up underneath 1040, where it says filing status. What are you filing as? Are you single? Are you married filing jointly? Are you married filing separately? That determines what tax rates you pay. So important that all those things are right. Important that your dependents are correct and that their social security numbers are correct and their relationship to you. And so that's all basically the first half of the front page of the 1040. Then we get down to the numbers. So from lines 1 through 9, you have your income sources. So you can see broken down exactly where your income came from. All those documents that you prepare to take to your tax preparer, your W-2s, your 1099s, all of those forms that you get in the mail or electronically now many times that are for reporting your income. You can see all of that information in lines 1 through 9. Okay. Then we have adjustments and your adjusted gross income on lines 10 and 11. And that leads to line 12, which is where is reported your standard or your itemized deductions. Do you take the standard deduction or do you itemize? And I'm going to talk a little bit more about that in just a few minutes. But you can see that information on line 12A down towards the bottom. It's bold. 12A, standard or itemized deductions. And then lastly, on the front page of the 1040, line 15, this is your taxable income. So this is the dollar amount that you actually pay tax on after all adjustments and your standard or your itemized deductions are accounted for. Flipping over to page 2, or sometimes the back side of that front page of the 1040, you've got your total tax on line 24. So what is your total tax? I can't tell you how many times if I were to ask someone, or if someone even were to ask me, how much did you pay in tax last year? Do you know the answer to that question? Do we know how much we pay in tax? We always know if we had, like I said earlier, we always know if we got a refund or if we had to pay in some more tax. But how much did we actually pay? And from these numbers, you can derive so much information. You can derive what was your marginal tax bracket? What was your effective tax rate? Meaning, how much tax did you pay on every dollar of income? So it's really important just to look at those numbers. Line 33 is prepayments, meaning did you withhold from your paycheck? Did you pay in estimated taxes? All of those, what I put on here were total prepayments. It's the law that we should either withhold throughout the year or that we should pay in estimated taxes throughout the year. So line 33 is going to show you how much was withheld towards your total tax liability. And then if you got that wonderful refund, that'll show up on line 35A. But if you owed tax, you didn't quite withhold enough to meet your tax liability, line 37 is going to show you where you owed, how much you owe. So that's just a really cursory overview of the front of the first 2 pages of your 1040, but it's just really important every now and then to pull that document out or after you get your tax return prepared this year and you get that back. I know we're all just a lot of times happy that it was filed and we know whether or not we got a refund or had to pay, but take a look at it so you can derive where all those numbers came from and what actually happened in the year. A lot of planning items can be addressed in the current year for things that happened on last year's tax return. Lastly, in this first key point, know thy tax return, is what we call the key financial data card. I have a copy of this card sitting here with me. Keep one on my desk. I keep one in my conference rooms. I look at this card multiple times in a day, and it's because it's such a handy reference for all kinds of tax information, particularly things like what are your tax rate schedules? What are those marginal tax rates that you may fall in? What are the standard deductions this year? What are the capital gains tax rates and things like that? So I keep this as a handy reference. For you guys today, Betsy is putting one of the key financial data cards in the chat box for you to download as a handy reference. Download that, keep it on your desktop, take a look at it every now and then. If you have a tax question, a lot of the most common tax information is found on this key financial data card. And if you want more information about these numbers, I recorded a webinar back in January for Key Financial Data 2023. You can take a look at our YouTube channel and take a look at that video for just a deeper dive into the information on the Key Financial Data card. Okay, so number one, know thy tax return. Just take a look at it, know what's going on. And that leads to number two, which is save strategically. This graphic we affectionately refer to as our tax buckets, and that's because the way that you save over time will really help you in the long run when it comes to designing a retirement income stream for tax purposes. So just a real quick overview of the buckets. Tax deferred is there on the left. That's your pre-tax bucket, meaning all dollars that go in save you on taxes today. And that would be saving in accounts like 401ks, 403bs, your traditional IRAs. If you have simples or SEP IRAs, pensions and annuities also fall into that bucket. So in the current year, any dollars that you save in those pre-tax tax deferred buckets will be before tax, and that will help on your tax return in the current year. If we flip over to the right side of our tax buckets and we look at the tax-free bucket, that is going to be our Roth bucket or our after-tax bucket. And it's almost completely opposite. Just flip the tax-deferred bucket upside down. The tax-free bucket is we put dollars in now and we don't get to write those off, or we don't get a tax deduction for those contributions, but they're allowed to grow inside without any taxes. And when we take that money out in retirement, it's never taxed again. It's completely tax-free. Whereas when we take out dollars from on the left side here, the tax-deferred bucket, every dollar we pull out of the tax-deferred bucket has taxes attached to it. So you can just see by looking at the left and the right sides of the chart that if we save in both buckets, by the time we get to retirement, we can choose which lever we're pulling to either take dollars out that are taxable or take dollars out that are not taxable. And when we do that, we can help level out our overall tax rate and the amount of tax that we pay over time. Now, there is a middle bucket called the tax advantage bucket, and that one is noted as after tax going in, but taxable coming out. Those types of accounts are just like brokerage accounts, savings accounts, accounts that generate qualified dividends and capital gains. And the reason we call this tax advantaged is while we don't get a deduction for money that goes into this bucket, money that comes out of this bucket gets a preferential tax treatment. Capital gains and long-term capital gains and qualified dividends are taxed at a lower rate than ordinary income. So that's also a really nice bucket to save in, to have as an option when it comes to building out a retirement income stream. Now, how does this help you now? Well, obviously, putting more dollars into the tax deferred bucket there on the left is going to lower your tax liability today. But we can't just think about today. We have to think about the future as well. So if we're in a lower tax bracket today than maybe we think we will be in the future, perhaps we should consider maximizing what we can do in the tax-free bucket first, and then tax advantage bucket before we put all of our savings in the pre-tax bucket, so that we can save the pre-tax bucket for later on down the road when we're in a higher tax rate. So as you approach retirement, sometimes you are then at that point in your higher earning years and you're naturally in a higher tax rate. That is the time when we should consider maximizing as much as possible into that tax deferred bucket, because that's going to lower our tax liability now. So just to use a very bare bones example, what if your effective tax rate now, or if your marginal tax rate now is 12%, you should probably be saving all in the after tax bucket as much as possible, or in tax free or in tax advantaged. But if you're in the 22, 24, 32% brackets, perhaps you should consider saving in the tax deferred bucket now, so that you lower your tax liability and then later on pull those dollars out at a 12% rate. So saving strategically is the key point here. And that means, where are you in your life cycle? Are you in the accumulation phase? Are you nearing retirement? Are you in early retirement? And how do we save across the 3 buckets to make sure that we have each bucket to pull from in retirement? So that is saving strategically. Moving on to number 3, bump the bracket with Roth conversions. So I just explained to you guys the concept of that tax-free bucket, and that's Roth IRAs, Roth 401ks, Roth 403bs. And I talked a little bit about those tax brackets and when you would save, when should you maximize those contributions. Well, what about conversions? What are conversions? Well, let me flip back to the bucket for just a second. What happens when you pull money out of a tax deferred or pre-tax account and you move it over to the right side to your tax-free bucket? That's called a conversion. And that's an awesome tool to use when you want to move funds from your pre-tax situation to your after-tax situation. The problem is, when you do the conversion, it's taxable income to you. So that's also a strategy in itself, is Roth conversions. So now to go back to the third point, bumping the bracket. What if just normally your normal income situation puts you in the 22% tax bracket, but maybe you haven't filled up the 22% tax bracket. And maybe you think later down the road in your higher earning years, you're going to be in the 24 or the 32% tax bracket. Well, then it makes a whole lot of sense in a year when you're in a 22% tax bracket and you have more room in that bucket to do what we call volunteering to pay some tax and doing a conversion to fill up the 22% bracket. And that's what our little watering can here is showing, is that before the conversion, maybe our income has filled up half of our 22% bucket and we still have some room left. So then we do enough dollars of a Roth conversion. We pay tax on those dollars at 22% to fill up that bucket. So that now forevermore, those dollars we paid 22% tax on now, instead of 24 or 32% later, and later on down the road, we get to take those out tax-free. So that's a strategy we call bumping the bracket. This is a strategy that is nice to implement during that accumulation phase or those working and earning years, when you are filling up your buckets, your income buckets with your natural income, and we see where we're positioned and anticipate what your tax rate is going to be later. So that's bumping the bracket. Skipping ahead to number 4, your BFF, the HSA. So why is an HSA your best friend forever? An HSA is a health savings account, and while a Roth IRA is one of the best retirement accounts that you can own, the health savings account is the most tax efficient account that you can own. And it's because you get a triple tax benefit on an HSA. So the caveat is you have to have a high deductible health plan, health insurance, that is qualified for having a health savings account. But what happens when you contribute to an HSA is you get a deduction for the money that you put in. So the money in is not taxed. Then the money inside the HSA can grow, and it can be invested without any tax. So tax deferral there. And then when the money comes out, if it's used for approved medical expenses, it's not taxed either. So that's a triple tax benefit. A lot of the questions that I get on HSAs are, well, what if my employer doesn't offer an HSA? That's okay. You can open an HSA on your own as long as you have a high deductible health plan that qualifies for an HSA or for you having an HSA. You can open one individually. There are platforms out there where you can open an HSA that have investments inside so that you can invest that HSA to grow. And then a lot of times the other question that I get about HSAs is, well, do I have to spend the money on this year? Do I have to spend the money I put into it this year? And no, you don't. That's one of the great benefits of HSAs is you do not have to spend the money in this calendar year. In fact, it's a great retirement planning tool because you put money in now, you let it grow until you're retired. And then at some point in the future, when you have health expenses that you need to reimburse yourself for, you can pull that money out of the HSA. You can also save up all of your out-of-pocket expenses for years and reimburse yourself later for those expenses. So let's say that you get into retirement and you want to take a vacation that's going to cost $5,000. But you're already kind of at the top tier of a tax bracket and you don't want to take money out of an account that's going to cause more taxes. Well, if you've got old receipts from health expenses that you haven't reimbursed yourself for, and you have enough money in your HSA, you could reimburse yourself for those years old expenses, take out the $5,000 that you need because that would have been reimbursing yourself for those medical expenses. And then you can actually spend the money on a vacation or whatever it is that you need at that point in your life in retirement. So that's why the HSA can be your BFF if you have the opportunity to save in an HSA. Okay, we're about halfway through our countdown, or I'll count up, I guess. And number 5 is raise the standard, bunch your deductions. I hope you all like my cheeky Brady Bunch reference here, the deduction bunch. But to talk for a minute about standard deduction versus itemized deductions. It used to be that when we prepared our taxes, we wanted to create that list every year of all of those deductions that we had so that we could lower our overall tax liability by using as many expenses as we had that qualified as miscellaneous expenses to itemize our deductions. Well, the 2017 Tax Cuts and Jobs Act also changed the game on that by raising and actually more than doubling the standard deduction. And so the standard deduction for 2023, if you are filing as a single filer, is $13,850. If you're filing married filing jointly, is $27,700. And if you're blind or over 65, you get an additional $1,500 per person. So what that means is that for a married couple, you would have to have over $30,000 in itemized deductions before you would even consider itemizing on your return. And what are the things I mean by itemized deductions? So that's what we have in our box here. We have mortgage interest, which is, the big three. The big 3 or 4 are mortgage interest, SALT, which is state and local taxes, charitable gifts, and property taxes. Between SALT and property taxes, you're capped at $10,000 in deductions. That leaves mortgage interest and charitable gifts as the big 3, or 4, if you count SALT and property taxes separately. And for most people, those are the deductions that they have in a year that they are looking to compare. When I add those things together, are they more or less than for a married filing jointly couple, $27,700? There are some other deductions that you can take. Medical expenses, they have to be over 7.5% of your income. Investment interest expense. So if you borrowed money for an investment, you can deduct the interest expense associated with that. There are some disaster losses, and there's kind of a really short list of other miscellaneous expenses that you can deduct, but a lot of that has gone away with the new Tax Cuts and Jobs Act. I say new, it's not so new anymore, but with the current tax structure we're under. So that's why I say between mortgage interest, state and local taxes, charitable gifts, and property taxes, when you add those things together, if they're more than $27,700 married filing jointly, then you will itemize your deductions. If they are less, then you will just take the standard deduction. So if you're just taking the standard deduction and you make a charitable gift, that's fantastic because you helped the charity that you were concerned about. You made the world a better place. You helped out your community. We give out of the goodness of our heart, not necessarily for a tax deduction. But when it comes to taxes, if we're taking the standard deduction and making charitable gifts, we really don't get a benefit for our charitable gifts. So what if we do something that we call bunching deductions? And what that would look like is maybe, and I'll use charitable gifts as an example in this situation. Maybe we make a large charitable gift in a single year, and we bunch that together with our mortgage interest, our state and local taxes, our property taxes. Maybe we also had high medical expenses that year. What is a good situation for bunching a lot of expenses together that we can deduct in a single year? And then the following year, we don't make any charitable gifts. Maybe the following 2 or 3 years, we don't have those same type of expenses. We don't make as many charitable gifts. We keep our giving low because we gave on the front end. Maybe we don't have as many medical expenses and things like that. And that's a strategy called deduction bunching. And what it allows us to do is, in this example, get a tax benefit out of giving charitably, or get a tax benefit out of a year when we had higher than normal medical expenses. It also it works well sometimes in high income years when you have done something like selling a business. Maybe you want to give a large charitable gift and bunch those deductions so that you can itemize. But it's a strategy that can just help you get a tax benefit if you typically take the standard deduction. Again, a little complicated, a little probably vague to understand, but something to really take a look at and talk with your advisor or your tax preparer to see if it would be a good fit for you. All right. Number 6, doubling down with DAFs or double down with DAFs. And what is a DAF? A DAF is a donor advised fund. And I use this example in number 6, just following number 5 with bunching deductions, because a donor advised fund is one way that we can accomplish a charitable gift by deduction bunching. It doesn't have to be, but what is a DAF and how does it work? So a donor advised fund is where the donor contributes to a fund. It's an irrevocable, meaning you can't take it back, contribution, and it immediately receives the charitable tax benefit. So it's an account. You make a donation to it. You get to write off that donation as a charitable expense on your tax return. You hold the account, the assets grow, that can be invested inside, and the assets will grow over time. And then over time, you can grant out the funds from your donor advised fund to those charities that are near and dear to your hearts. So to go back to the example of bunching deductions and putting that together with doubling down with DAFs, in a year where maybe you want to bunch your deductions, you can make a large gift to the donor advised fund, and immediately you get to use that as an itemized deduction. And that can pair with your mortgage interest if you have that, or state and local taxes, or medical expenses, or whatever other itemized deductions you have to get you over the hump, over the standard deduction hump, and into itemizing. What do I mean when I say doubling down with DAFs? A donor advised fund can also be a great tool for giving away capital gains without any tax consequences. So let's just say that you inherited a stock 20 years ago, or you bought a stock 20 years ago, and that stock has grown pretty significantly. What happens when you sell that stock is you take a capital gain and you owe taxes on that capital gain. But what happens instead if you use that stock that has grown and you give the stock directly into a donor advised fund? You get to take the deduction for charity of the gift of the full value of that stock, and you don't have to pay tax on the capital gain because you didn't liquidate the stock. So you gave away your capital gain, you gave away the tax that went with it, and you were able to deduct the full amount of the stock as a gift to charity. So that's what I mean by double down with DAFS. You can use it in the deduction bunching strategy, the itemized deduction bunching, but you can also just use it if you have securities that have high capital gains and you're charitably inclined. You can give away those gains. So basically what cost you pennies on the dollar is what you use to make that same gift, and you get a tax benefit from it. So we really like DAFs. Donor advised funds are a great way to support your charitable causes and also help you from a tax perspective. Okay, what's next? Number 7, QCDs, if you please. So the donor advised fund strategy works wonderful if you have securities that have grown, if you want to bunch your deductions, and typically if you are in your accumulation phase of life and or in early retirement, or what we call transition phase, before age 70 and a half. After age 70 and a half, we like to flip our giving strategy over to what we call qualified charitable distributions. And how does that work? You can give up to $100,000 from an IRA per person directly to charity, and it's not reported as income. So the only way, and if you'll refer back to what I was sharing with you earlier about the tax buckets and the bucket on the left, the tax deferred bucket. And when I mentioned that when you pull dollars out of that bucket, every dollar is fully taxable. The only way that you can get funds out of a traditional IRA without paying tax on it is by giving it directly to charity. And that's what's called the qualified charitable distribution. So you can still do that as early as age 70 and a half, even though the laws have changed on the required minimum distribution age. That's now age 73 or age 75, depending on when you were born. But the law still allows for QCDs after age 70 and a half. And what you would do is simply, instead of giving out of your checking account or your savings account or potentially out of your donor advised fund, you would make a gift to those charities that you care about directly from your IRA. And it's like the income never even happened to you. You get no deduction for that charitable gift, but the income itself, you don't have to report on your tax return on the front of the, it's deducted on the front of the 1040. And in tax language, anything that we can reduce on the front side of the 1040 is better than any deduction or anything we do on the back side other than tax credits. So QCDs, if you please, they're a fantastic strategy for giving post age 70 and a half, and particularly when paired together with a required minimum distribution strategy. All right, moving on to number 8, harvest in the fall. Or should I say tax loss harvest in the fall? And by the fall, I don't mean the season. I mean, what happens when the market drops? What should we be paying attention to? Well, obviously, there are lots of emotional concerns when we have market drops. We don't like to see our accounts fall in value. We worry about what happens, how that impacts our future. So in this situation, what we try to do is, how do we make lemonade out of lemons? How do we take a situation where the market has dropped and make that work to our advantage? And this is a strategy that works in that middle bucket, the tax advantaged bucket. Regular brokerage accounts that have investments inside. So when you own investments and when those investments go up and down in value, it's not what we call realized until they're actually sold. So here's an example. Number one, we buy ABC investment and we purchased it for $100,000. Let's say the market falls by 20%, and now that ABC investment is worth $80,000. It's just a loss on paper until we sell it. So step two is identifying that there's a loss and then actually selling that investment at a loss. But we don't want to lose our upside potential. What happens if the market bounces back? So that's where step number three comes in. We buy XYZ investment, which is similar maybe to what ABC investment was, and we expect the performance to be similar, but not substantially the same. And we buy that investment for $80,000. And then hopefully that investment then will get the same market appreciation as we expected from ABC investment over time. But why did we sell it? Well, the reason why we sold it again is because it's only a loss on paper until you actually sell it and realize it. So now, as you can see in the green on this slide, because we paid $100,000 for it and we sold it for $80,000, we have booked a $20,000 capital loss. What can we do with capital losses? Well, the first $3,000 of a capital loss can be used to offset income. So it just reduces your tax liability up to $3,000, or I'm sorry, it reduces your income up to $3,000 on the front side of that 1040. We also use those losses to offset other gains, because as we all know with investing, sometimes some things are going up and some things are going down. So what if we match those things together? Something rose, something fell. If we sell them both that have a similar gain and loss, then we've just completely offset the capital gain that we may owe tax on by generating a loss. But we haven't lost the potential for those assets to do well in the market going forward because we bought into something else that should participate in future market growth. So it's just a way to take advantage, again, make lemonade out of lemons when we see the market going down, and a nice way to book some capital losses that we have to offset capital gains either now or in the future. You can carry forward capital losses. So if we can't use them all this year, if in this example, we booked $20,000 of capital gains, we only had $7,000, I'm sorry, we booked a $20,000 capital loss. We only had $7,000 in gains, then we can take $3,000 and write that down on the front page of our 1040. We still have $10,000 of a loss left that goes forward with us into the future. And so that next year, if we had a $10,000 gain, we have a loss sitting there that can offset it. So it's just a nice way to, over time, pay attention to embedded or gains that are building up in our accounts and eliminate those gains and eliminate those taxes. We are rounding to the top, guys. So number 9, dominoes, torpedoes, and cliffs. Oh my. There are quite a few things that can wreck our tax plan unintentionally. And to briefly describe what a few of those are, the domino effect, the extra income domino effect. Sometimes things happen and we take extra income and we don't realize how that's going to impact other areas of our tax return. So for example, when I'm looking at the key financial data card that I referenced earlier, and I'm looking at tax rates on long-term capital gains, long-term capital gains have a 0% tax for married filing jointly if your income is less than $89,250. So let's say that you had taken some gains, you had accounted for all of your income, you had planned on paying 0% on those capital gains that you had paid because you were keeping your income under $89,000. What happens when there is an extra dollar? So if there's one extra dollar and you go up to $89,250 $89,251 taxable income, you automatically bump up into the 15% capital gains tax bracket. And it's not just 15% on the next dollar. It's 15% now on all the gains that you took. So that's just one example of an extra income domino effect. There are other things like there's the 3.8% tax on net investment income. And that is in net investment income or modified adjusted gross income over $250,000 if you're married filing jointly. And that also is a domino effect. $1 over, then you get to pay 3.8% extra tax now on anything over $250,000. So sometimes we unintentionally trigger a domino effect by taking $1 or more in income, and we don't realize it. So that's something to pay attention to. The Social Security tax torpedo. Many folks don't know that Social Security is taxable to an extent, that is it's a bracketed tiered schedule, and the amount of Social Security that is subject to tax is dependent on your provisional income. And there's a calculation for that. That's on that key financial data card on the second page. You can calculate what your provisional income is, but it's one of those things where if you take income from another source, for example, an IRA, let's say you wanted to go on a trip and you took out $1,000 extra from your IRA to take a weekend getaway or something. Well, at certain income levels, not only do you pay tax on the distribution from the IRA, but it kicked some dollars of your Social Security into a taxable situation, so that now you're also paying some additional tax on more of your Social Security. And that's what we call the Social Security tax torpedo, where extra dollars from another source can also cause extra taxes on your Social Security and therefore cost you more than you anticipated. So that's the Social Security tax torpedo. And then last in this example is the IRMA cliff. And what do I mean by IRMA? I mean income related monthly adjustment amount that relates to Medicare. So another thing about another important item about your income is that your Medicare premiums in retirement are completely related to what your modified adjusted gross income is. So the more modified adjusted income you have, depending on what bracket you fall in, will depend on how much you and also your spouse, if you're married filing jointly, pay for your Medicare Part B and Part D premiums. So what do I mean by cliff? Well, this is one of those things where one extra dollar can bump you completely over the edge and into the next tier. So it can cause you hundreds or thousands of dollars more in Medicare premiums, which is not exactly a tax, but it kind of is a tax, if you don't pay attention to staying under or within a certain modified adjusted gross income tier structure. So those are things to watch out for. Domino effects, Social Security tax torpedoes, and IRMA cliffs. And by this time, you may be thinking, gosh, these 9 things are a lot of things to pay attention to, and how am I going to do it? And that's why my very last key tip is never walk alone, or you'll never walk alone when you seek professional tax guidance. And I say that because everyone's situation is different. No 2 tax returns are the same. No 2 family situation is the same. And a lot of the strategies that I've mentioned today, putting the data in correctly is essential. Knowing how to input the forms, knowing, for example, a Roth conversion, knowing the forms that you need, knowing how to input that on the return, doing a donor advised fund. How do you know how to tell them what your cost basis was when you made that gift, or what the value was on the data that you made that gift? Bunching the deductions. A lot of these strategies, doing these things, inputting the forms and the data correctly is essential. And it's really helpful when you have collaboration. So your dream team here consists of you, your accountant, and your advisor. And I just believe that the 3 of us working together in collaboration is key to making sure that we're able to follow all of these 10 guidelines, or find the most efficient and effective strategy for each family and each situation. So that's my top 10 tax planning tips. A lot of these learned over time from my client situations or things that we share with our clients. These are the top 10 things I see. Go back to what's the summary here? And I think the overall summary is we have this mantra in our firm that is focus on what you can control. And I've spent a lot of time today talking about the second point here, which is taxes, because taxes are, to an extent, one of those things that we have control over. There's so many things when it comes to saving and building for retirement, or having a successful investment experience that are out of our control, like natural disasters, world governments, news media. We don't control any of that stuff. All of that is completely out of our control. So the best we can do is to focus on what we can control. We can control costs that we assume with managing our investments and managing our portfolios. To an extent, like I've gone through today, we can control taxes. At least we can be aware of where we sit tax-wise and make decisions appropriately. We can manage the risk that we take with our investments and with our overall financial situation and work to eliminate or reduce those risks. And really, it all comes down to decisions. We used to call this one behavior. And we used to say, we give you a good star, a gold star for good behavior. But the decisions, we want to help people make smart decisions throughout their journey of financial planning and into retirement. And focusing on what we can control will help us make the best possible decisions. So with that, we are available if anything has piqued your interest today and you'd like to request a taxes and retirement planning overview meeting. Happy to do that. I know taxes are something that I always get a lot of questions on, particularly this time of year. So we're available. We'd love to sit down with you and have that meeting if it's something that is interesting to you. And at this time, I will pitch it back to Betsy for any questions.
Thank you, Dan. That was so informative, as always, and right at the perfect time of year. We do have a couple questions. The first one is, when you were talking about early retirement, what is considered early retirement? Is that just before you make your required minimum distribution?
That's a really good question. Early retirement can be considered a lot of different things. And so there are a lot of different benchmarks. So age 55 is the age that a lot of retirement plans may allow you to retire and take distributions without penalty. So that's one checkpoint there. Age 62 is the earliest age you can take Social Security. I think that I know that the decision on whether or not to retire and to take Social Security are completely independent. You don't have to take Social Security just because you're retired. It needs to be an optimal strategy. But that's one benchmark. 65 is when a lot of people are forced to start pensions. So that's one benchmark. And age 70 and a half is a benchmark that I mentioned, because that's when you can start taking qualified charitable distributions. And then age 73 or 75, depending on when you were born, are now when you have to start taking required distributions. So early retirement can mean a lot of things, and it really depends on where you are in your life cycle. But we call the transition phase an early retirement phase, and that would really mean any phase from the day you retire until you turn your required minimum distribution age of 73 or 75.
Okay, very good. And then going back to the Roth IRA conversions, is that something, so if you've already reached your peak earning years and you're probably not going to go back into some lower income years, is there any reason to do a Roth conversion if you feel like you're just going to be taxed phenomenally?
I would say no. I would say that if you're in your peak earning years and you don't anticipate that your tax rate is going to be higher later, that you probably shouldn't do Roth conversions. The only thing that I could add to that, though, is depending on where you sit in the tax brackets, because if you sit in a place where, although you may expect your income to go down in the future, it might be at a place where we anticipate that tax rates, we anticipate that tax rates aren't going to get any lower than they are right now. We're in one of the lowest tax structures that we've ever been in history. So if we think about what Congress or legislators are going to do, more than likely, we're not going to see any kind of reduction in income taxes. So just because you may be in a higher bracket that you think is higher to you right now, that doesn't necessarily mean you won't be in a higher one later, even if you do take less income. So that's something to also evaluate. If you sit in a 22 or a 24% tax bracket, you might actually be in the exact same or in higher tax bracket in retirement if Congress raises tax rates. That being said, we can only really go on what we know right now and what's for sure. And so what's for sure is if you're in a high tax bracket now, you should probably be doing some things to lower your tax bracket, like tax deferred bucket, and focus on tax Roth conversions later.
Very good. Makes sense. Thank you. I'm going to go ahead and share my screen real quick and just wanted to make sure everybody is aware of the different ways that they can reach us. So the first thing is we have a YouTube channel. If you haven't seen it already, be sure to go and look for Elevate Wealth Advisory in Athens, Georgia. Make sure you're looking for that one. We are putting out weekly content, weekly videos, and this year we're focusing on the 27 principles of investing. So they've been very, very interesting so far, and I know you'll enjoy that. Be sure to hit the subscribe button and you'll get a notification every time we have a new video. We're also posting videos with some of the charities that we're supporting this year. Deanne has been interviewing each of those. We're giving $1,000 each to 40 charities in honor of our 40th anniversary this year. And so it's been really fun to post those videos up too. And then finally, our website, elevate-wealth.com. You can go here and you can navigate over to the bar and find future webinars. You can read blog posts and find other resources. So be sure to tune in next month. We have a guest speaker, Christian Newton, will be joining us to talk about what Deanne said earlier, behavior, and how your good or bad behavior could affect your portfolio. So Deanne, before we go, I think we have one more question. Nope, okay. That's one. It's been answered. So thank you all for tuning in. And Deanne, thank you as always for your insight on this topic and every other one. And again, we'll send you the link later today to our YouTube recording of this that you can share with your friends and family. Thanks.